Okay, good morning, everyone, and welcome to our second event this week in the Coffee Microcaps Appendix 4C Results Wrap. My name is Mark Tobin. I'm the founder of Coffee Microcaps, and you're all very welcome to this morning's event. I'm just quickly going to run through some intro slides, some event admin, and then we'll get straight into it with our first presenter. First, I'd like to thank our virtual event sponsor, Meriwether Capital, Luke Winchester, who I'm sure you would know. For anybody who's in the FinTwit community, he's launching his own microcap fund. So please be sure to check out the PDS on Luke's website or reach out to him if you've got any questions about his new fund. Quick compliance and disclaimer. For anybody joining us for the first time, the typical companies we have at this event, and indeed the Coffee Microcaps morning meeting, is they're companies with a market cap under 300 million, generally in revenue and approaching cash flow break even, or indeed are already profitable, generally from outside the resources and biotech sectors. So what I like to call industrial microcaps, which is a catch-all term for kind of all those other sectors. So in microcap technology names, microcap financial services, microcap industrial products or services businesses. So it's kind of all of those other sectors. Structured this morning's webinar, we're going to have 4 companies rather than 2 presenting over the space of the next hour. It's 30 minutes for each company, roughly broken down into a 20-minute presentation and 10-minute Q&A. If you do have any questions for our presenters, please type them in the Q&A box rather than the chat function. It just makes it easier for me to moderate the questions to our presenters. Please note the webinar is being recorded and will be posted on the Coffee Microcaps YouTube channel probably about lunchtime tomorrow. If you want to follow Coffee Microcaps, you can get us on Twitter, YouTube, as I said, for this recording, yesterday's recording, and indeed all the Coffee Microcaps morning meetings we've had over the last year and a bit. LinkedIn, and I also write a weekly paid subscription newsletter where I profile one interesting ASX microcap stock every week, and you can get that on the Substack newsletter platform. We're going to quickly jump over to Joe Hanna, our first presenter, in a second from Proptech Group. And just to give you the full lineup, then we're going to have Christopher Clark from Delta Drone joining us from Adelaide. Then we're going to skip over the border into WA. We've got Brian Leedman from Nutritional Growth Solutions. And then we're going to stay in WA for our last presenter. We've got Dr. Ben Cole from Wide Open Agriculture. Without further ado, I'm going to stop sharing my screen because I know Joe is waiting patiently to join us and share his screen. Joe, if you want to share yours quickly.
Excellent. Thank you, Mark, and thank you all. Sorry, go for it.
No, I was just going to say I can see the cover slide of your presentation now, Joe, so you're good to go.
Excellent. Thank you, Mark, and thank you all attendees for joining to provide an update on Proptech Group's continued growth throughout the first quarter of FY22. For those of you that are unaware, Proptech Group provides market-leading SaaS technology that real estate agencies depend upon in order to run their back office operations. 2 out of every 5 real estate agencies in Australia and New Zealand use a Proptech Group platform or product in order to run their back office. Typically, and largely that penetration stems from our sales CRM product, which enables end-to-end management of property sales. So without that, real estate agents cannot basically run their business. We've had a very good start to the financial year with a massive increase in our cash receipts from customers, maintained a positive net cash flow, and are certainly well capitalised for continuing that growth throughout this year and into next financial year and beyond. We've completed a $15.5 million capital raise during the quarter, completed the acquisition of Eagle Software, which bolsters our capabilities, particularly within the independent, franchise, independent and small multi-office space within the real estate landscape, and announced the intention to launch a JV to address payments and cash flow solutions for the real estate industry, which I can cover off throughout the deck. Just in terms of our growth and evolution of growth in terms of cash receipts, we've experienced a 99% growth in cash receipts for the first quarter of this financial year when compared to the last, and 23% up from quarter on quarter. More importantly, as we're a SaaS business with over 85% of our revenues being derived from monthly recurring revenues across long-term contracts, we've shown consistent growth in our annualized recurring revenue, with an increase of almost 70% when compared to June of last year, June 2020, and a 31% increase in the last quarter alone. Now, organic growth in this has been really driven by our ability to upsell to our existing customer base of those using the CRM product, additional products and services, as well as an aggressive acquisition of new agencies through our sales and marketing team. Acquisitively, growth has come from the Eagle acquisition, which has contributed more than 800 agency clients starting from July of this year. In terms of our customer evolution and of growth, again, we've seen solid, consistent growth in the number of agencies using our platform, added 865 net agencies in the last quarter alone. And we continue to grow that customer base with 44% increase in the last quarter when compared to June 2020, and 21% increase quarter on quarter. Again, key drivers of that growth stems from the implementation over the past 12 months of a centralized sales and marketing team, which are really focused on delivering strong organic growth, retention and addition of some very key customer franchise groups, including Ray White, Harcourts, and a couple of others that enable us to then do a single deal across the entire network for a given franchise group. And clearly we've made the acquisition, as I mentioned earlier, of Eagle Software, which again further bolsters our capabilities and customer base. Our growth in market share has really been one of the core underlying pillars to our growth strategy since we listed the business in November of last year. So it's good to see that realization of that growth strategy being executed, and certainly we see that growth to continue, albeit probably not at the rate that we've seen it now, but certainly to continue to grow steady. ARPA, which represents the average revenue per agency per month, again a key driver of our performance, has also grown consistently. The way that we extract ARPA is by essentially the SaaS revenues we charge for a given product. The way we grow ARPA is to sell more products to our existing customers and bundle multiple products in when we provide and onboard new customers. So we've seen, as I mentioned, steady growth consistently since listing, 19% when compared to June of last year, and 12% on quarter. Most of that growth has been attributed from the introduction of new products and services, some of which have been through acquisitions such as Designly and Website Blue. Others have been inbuilt innovations from our R&D team. And these products and services are being upsold to existing customers or bundled into new customers. We've also increased prices and will continue to increase prices annually, given there's some price elasticity when compared to our competitors. And of course, the Eagle Software acquisition of the last quarter has also bolstered those numbers. Let me just talk through the market opportunity. Now, apologies, I'm missing some slides here. Something's happened. Oh, that stops sharing. Sorry. Don't know what's happened here, Mark. Let's try that again.
Okay, just
sincere apologies. Let's share again.
Let's just share again.
There we go. Sorry, guys. Technology company with technology failure. So excuse that little mix-up. In terms of our growth strategy from here, well, what's really interesting to note that, as I mentioned earlier, we provide the core software that 2 out of every 5 real estate agencies depend upon in order to run their daily business. What's interesting though is that the real estate agencies in Australia alone spend $730 million annually purely on SaaS Proptech. That includes things like RP data, their subscriptions, but not listings on the portals, domain, real estate, and all the other Proptech players in the space. Given those numbers, PTG represents a very small proportion of that expenditure, capturing only 2% today. So we clearly have an ability to grow our share of that expense by executing on these strategies. First and foremost, and historically, market share has been our primary driver of growth. Now that we have a 41% market share, we look to expand our product range to offer additional products and services really aimed at capturing additional workflows, providing enhanced efficiencies, automation, and opportunities for real estate agencies across every stage of property buying and also renting life cycle. So our number one strategy for growth involves adding additional products and services that are integrated deeply into a single platform hub that address the needs of the entire agency operations across real estate. Secondly, we aim to grow our ARPA. And as I mentioned earlier, this is a fundamental factor of upselling, cross-selling, and price increases, all of which we will continue to do and are starting to gain some pretty significant traction, particularly around the upselling cross-sell. So as we expand our products, we have a large customer base that we can continue to upsell with, and expanding our product also enables us to capture an increase in our market share of new agencies. The fourth strategy for growth is centered around entering new markets. We do have a presence in Australia, New Zealand, and in the UK. Our presence in the UK, as previously disclosed, is roughly around 1% of the market. The UK represents a significant upside opportunity for us to essentially take the playbook that serves us well to date in Australia and replicate that in the UK. It's a very similar market in terms of market structure, but significantly larger and significantly less tech savvy or less sophisticated. So as a global rule, Australian Proptechs have a tendency to really punch above their weight in terms of innovation, as you can see with the largest real estate portal in REA being valued at so high, given we're such a small nation. Opening new markets also relates to opening new sectors within the markets we operate in. And I'll talk to those in a moment. But clearly, our strategy is centered around doing more of what we have been doing, increase our product range, grow our market share, leverage off that strong penetration within the Australian, New Zealand real estate agency space to offer additional products and services, and thereby growing our average revenue per agency, primarily in SaaS, but increasingly there are opportunities to inject ourselves further into the transaction stream. In terms of our growth, we are a growth through acquisition as well as organic. We certainly don't rely solely on acquisitive revenue. Organic revenue is a core part of our growth, but typically there's an opportunity for us to grow, fast track both our growth and the growth of companies that we acquire or invest in by giving them access to our large customer base across Australia, New Zealand, and more importantly, giving them access to that customer base in a way that's tightly integrated and deeply integrated into our core single platform. So let me explain that a little bit further. Our platforms, primarily our CRM platforms, are used by agents all day, every day. It's the one system that is their source of truth for everything related to properties, transactions, back office, trust accounting, particularly those that deal with prospecting, listings management, advertising management, settlements, sales, auctions, end-to-end process for sales. So if you are a Proptech, of which there are over 300 Proptechs operating in Australia alone, either in the early stage of your operation or in the scale-up stage, you at some point in time will need to integrate with a CRM because the CRM is the source of truth and where all the data is stored. Typically, those integrations require work on both the CRM side and the supplier or the third-party Proptech side. Where we differ is that we have an open API that encourages interoperability and deep integration with best-in-breed Proptechs, and we leave the decision by and large to our customers, although our account management team will certainly consult over our opinion on the best-in-breed integrations to essentially integrate with whatever party they choose. However, as we find with other SaaS businesses in other industries, the depth of integration, the ease of integration, and removing barriers to adoption are key drivers to growth. So if you can make it easier for the agents and the users to execute on a third-party transaction, be it an additional product or additional feature set that services a very specific niche of the flow, rather than have them log out of the platform they use all day, every day, which is a CRM, to log into another platform. Deep integration, we know, results in much faster and higher adoption. So we've proven with the acquisitions we've made to date that under Proptech Group's banner, we can grow those businesses fast by integrating them into our centralised platform hub and leveraging our centralised sales and marketing teams and structure. Remembering we have 41% market share across Australia and New Zealand. So if you're looking to start a Proptech business and want to gain access to that market share, we're clearly the distribution partner of choice. That then leads us to some pretty significant deal flow and an evaluation of that deal flow is where we really stand out. So we're currently seeking partners either through merger, acquisition, or investments that have the ability to help us increase our market share or increase our ARPA through expanding our product range or potentially opening up new markets. We have the ability to rapidly scale them overnight, essentially, into market leaders by providing them access to our 5,000 odd agencies across Australia and New Zealand. Again, that access is driven both from our sales and marketing team, but probably more importantly, driven through deep integration within the platforms themselves. The agreements can take the form of acquisitions, cash or script, investments. More and more, we're looking at opportunities to take smaller stakes in companies where we're not necessarily convinced that they're ready and want to prove them out, or if we need to, just pure commercial strategic partnership, revenue share type agreements. We certainly have a strong preference towards investment or acquisitions, and increasingly we're looking at investments through performance-based equity earnings. Now, let me explain that a little bit further. If we see a product and service that extends the capability of our core, we believe that there is a need for the product in market, a desire from our customers to want to integrate or use that product, then we can essentially build in, or have been essentially building in, capabilities to deeply integrate that product, distribute that product, and as distribution and adoption occurs, we're able to earn in equity. Now, this is an interesting approach for us because what it does is it reduces the need for us to go out and raise, even more funds to make acquisitions. It de-risks those acquisitions not working, but gives potential upside by earning in equity. That gives us optionality post-performance to make an informed decision over whether we look to acquire the entire business or continue to hold a smaller equity stake. I'm going to spend a little bit of time in closing just really articulating the opportunity set beyond purely what we're doing today. As I mentioned earlier, annual Proptech spend from agencies in Australia alone totals $730 million a year. Now, when you take our revenues, particularly based on revenues from FY21, that represents only 2% of that total market spend. Clearly, we know there's a massive opportunity for us to grow those revenues, given that we have a 41% market share of agencies using that product. Now, it's important to note that there are some very large players taking chunks of that $730 million. However, they're not displaceable, and they're certainly spread over a vast number of PropTech companies. As I mentioned, over 300 PropTech companies operate in Australia alone. So what's our strategy here? Quite clearly, keep doing more of the same. Grow the share of agency spend by adding new products, services through cross-sell and upsell, and continuing to increase our market share of agency. In doing so, we're able to reduce our agency's total spend on technology, but increase our share of wallet. I wanted to call out the spend on VPA advertising, which is the ad spend for vendor paid advertising. Now, this is a $1.5+ billion industry, and it's by and large being swallowed up by Domain and REA and the other portals. Social media, traditional offline media are all vying for a slice of that. But typically the revenue generated in this industry is funded primarily by vendor paid advertising, with some brand advertising spent from the agents. So if you consider the opportunity where realestate.com, Domain and the other portals, primary business are really fighting for an opportunity that's a $1.5 billion total opportunity. We're fighting right now for an opportunity that's essentially half that. It really does represent the opportunity, the value, long-term value potential within the PropTech group. In VPA, to be fair, our strategy is we don't have a play there right now, and nor do we intend on trying to compete with a very busy and sophisticated advertising landscape. However, we will have some exposure to that spend through the PropPay product, which enables us to offer pay now, pay later, or pay on settlement solutions and capture a small slice of those fees and total spend in doing so. More exciting though is the ancillary products and services. So we know, and we've seen realestate.com, Domain, basically every PropTech player is trying to get a slice of the massive ancillary services that are in and around the core property transaction. Now, then these includes mortgages, insurances, utility connections, and typically originations of those from agents are able to share in some of those commissions, along with referral fees for services such as conveyancing, maintenance and repairs, and the like. Our strategy is we have deep integration through our agency workflows because they use our platform in order to manage those. Increasingly, what we'll do is to extend the capabilities of those workflows and start to offer ancillary services that are deeply integrated and then share in some of that revenue. To give some context, just purely based on sales commissions alone, typically an total agency commission pool is about $16 billion. We have no intention of trying to capture a portion of that or compete directly with our agencies. We're a champion of agencies and seek to make them more profitable. However, we will have some exposure via the early release of commission product that PropPay will provide to give us exposure into the space. I'll wrap up here and mention we do have a highly strong board of experts. Simon, as most of you would probably have heard of, is an industry leader, global industry thought leader, and as is Georg Schmiel. So again, apologies for the little technology hiccup, but I'll end there, Mark, and open up to you for questions.
Thanks, Joe. Maybe I'll just kick off while we're waiting for one or two to come in from the audience. In terms of seasonality in the business and for renewals with agents, is the first quarter that just happened now because it's the start of the new financial year, is that a big quarter for renewals, or is it pretty much even throughout the 4 quarters?
Yeah, it's a good question. So unlike the macroeconomic factors, because we're a SaaS business, there really is no seasonality apart from the general. You don't get a lot of business over the Christmas period, but that's across all industries. So typically for us, the contracts will be for the large franchise group, multi-year contracts, and for the independents and the smaller groups, annual contracts. They're spread essentially across the year, but really we don't see any seasonality when it comes to the adoption of our core system. I guess the big jump quarter on quarter was attributed fundamentally by the Eagle acquisition, but also some increases in prices and some organic initiatives. But typically, month on month, there's no driver or seasonality or external factors that will drive that. I guess the other way for me to articulate that is the systems that we operate are core to running agency. So if our systems are down, they're not doing business. The sales agents on the road are spending all day, every day within our app on the phone, and the admin staff and principal back office staff have our apps open all day, every day in order to manage transactions, including the trust accounting, collection of cash and distribution of cash, all of which are compliant under relevant state level legislation. So, and if you consider what I mentioned earlier, that the technology spend on Proptech versus other Proptech group rather versus other Proptechs, as a percentage of agent revenue, it's extremely small. So we're able to deliver significant value for a very low price. Now that's true for CRM, primarily CRM companies around the world, and we've seen evidence of this clearly. But both myself, Georg, Simon, and Sam on our board have all seen this as we've all worked for portals or ran portals before. When you run a property portal, having access to the agent's desktop through a CRM or a property management platform is always very exciting and very attractive, because it enables you to get a deep appreciation of the workflows, the unit economics, and the processes of running an agency. What we find though is that they're very difficult businesses to run in terms of it being extremely feature rich, extremely tuned towards the real estate industry, but agents typically don't pay a lot of money for them. So as a SaaS business standalone, yes, they can be highly profitable, but they do require ongoing investment and innovation. But unlike other enterprise SaaS businesses, and typically it's other CRMs like Salesforce, I mean, the fees that Salesforce charges are multiples of what we charge. Typically, a single user in Salesforce is almost half of our ARPA. So really, these types of real estate specific software solutions, just traditionally and as a factor of history, have always been fairly cheap in terms of the cost to agency, but extremely very feature rich. For us, they provide us with a very big opportunity to grow our market share, and then leverage off that market share to start to introduce products and services that are significantly higher yielding. Examples of which are marketing automation, websites, big data, matching, and some of the things that we've already done, let alone the things that we're set to do in the future.
Yeah, thanks, Joe. We've got two questions, but I think you've kind of answered the first one, and it was how do your charges compare to your CRM competitors? I think you called out Salesforce there, saying you guys are roughly half of that. So the question was, is there scope to increase ARPA over time? I think that's fairly self-evident. The second question, Matt.
Sorry, Mark, I can probably answer that one a bit better. So the only real estate agents that would use a Salesforce would be very, very large multinational commercial agents like the CBREs of the world, or and essentially that's because it is so extremely expensive, and a CRM for real estate is not just contact relationship management. So to answer the question more specifically, yes, there are other competitors like us within the CRM space alone. In terms of our pricing compared to the Australian specific CRM competitors, we're still well below. The last price increase that we executed over the last 12 months gets us closer to parity, but there's still certainly room to grow. We expect double-digit increases year on year within our core products for the next 2 years.
Okay, great. And then one quick one, because we're just up on time. Market share in July was 41%. At the end of the September quarter, it was unchanged at 41%. Do you see organic growth possible from here? Do you have any targets?
Yes, absolutely. We do see organic growth possible from here. We do have targets. I guess the simple way to answer that is the growth in market share has been a very strong focus for us. It will continue to be a focus, but now the focus shifts, given our large market share, to ARPA growth, selling more to the customers that we have. We will see continued organic growth through our sales and marketing team in market share, but the fundamental growth of ARPA is going to be more important. The other point to make there is, we're unlikely to want to acquire another CRM. I think we'll be getting too close to ACCC potential and competitive issues. So certainly that growth will continue to be organic. What's our target? Look, is it unrealistic to expect that we'll get to 60%? I don't think so. I think that's certainly achievable.
Okay, great. Joe, we're going to have to leave it there because I do know Chris is standing by patiently. And we're just gone slightly over time. So thank you very much for your presentation this morning. If you could please stop sharing your screen, and we will get Chris's presentation up here shortly. Chris, if you want to start sharing your screen. Yeah, it's coming through now. Yeah, I can see the cover slide of your presentation now. Chris, you're good to go when you are.
Perfect. Thank you. And good morning, Mark. Good morning to everyone. Thanks very much for this opportunity. Today, I'd like to present to you the story about Delta Drone. This is not on our latest sort of quarterly update and webinar coming up tomorrow morning, so I'll share the link with that as well. But really, I sort of thought I would take this opportunity to really sort of share the story of Delta Drone and how it all sort of began. I'm one of the original sort of founders of a company called Rocketmine about 10 years ago, and I'm sure, as you can hear, my accent originally coming from South Africa. And the story sort of goes that I was selling another different technology product on a mine site. It was a BHP mine at the time. And I walked onto this mine site, and there was this really large broken drone in about 10,000 pieces all over this place. And I remember sort of chatting to the chief surveyor at the time. His name was Jacques Spear. And I said, Jacques, what happened here? And he said, look, these really slick Canadian sort of salesmen came in, sold us this drone, 10,000 sort of US dollars at the time. And they told me it was the easiest drone in the world to fly. And I said, well, Jacques, if it, what happened? Why is it sort of lying here all over the floor? And he said, look, it was easy to fly. It just wasn't so easy to land. And it really was sort of at that point that sort of came to that light bulb moment where I said to Jacques, I said, well, if actually you're just a mine and just focus on taking rocks out of the ground, how about you sort of give that to us and we take it over and run it as a sort of a full inclusive service. And that really what began the journey of what started off as a mining specific brand and has sort of grown into this sort of global drone services entity. And yeah, we're really sort of excited to start our journey in Australia and where that's leading. A little bit about what actually the Delta Drone business model is and how and what it actually produces. Our typical model is that we would put a permanent mine site. Our sort of secret sauce, as you per se, is we take very young people, generally out of manned aviation, normally with a sort of a private pilot's license. We are able to train them up, get what they call an IREX rating, which allows them to fly beyond visual line of sight. And we equip them with all the hardware and software needed to fly these very large mine sites and essentially digitizing mine sites every single day. And due to sort of the physics of drone technology, flying quite low and flying these long distances, we're able to generate this high resolution geospatial data, which is then into the mining process, not only for things like stockpile volume, so stockpile management and volume calculations, but also customers are using it for high wall monitoring and mapping. And we're even seeing it being ingested into the sort of the fleet the autonomous fleet, which is really driving the growth in the mining industry, particularly in iron ore at the moment. So it's all about this frequency of the data, which really sets us apart, because opposed to satellites, which only come over once a week, or aircraft, which maybe only come also once a week, once a month, drones can fly every single day. And the key missing part is what we're finding, especially in the local market, is there's been no sort of single company that sort of offers it all in one at a really enterprise level. And I'll delve into that a little bit now. Excuse me. So maybe for a little bit of context, a lot of people, when they think about sort of the drone sector and the drone industry, everyone thinks about this little DJI drone. We've all probably got a Mavic sort of sitting on the shelf somewhere, and really sort of talking to this consumer side of the drone economy. And while that is definitely large and big in its own right, it's that those kinds of aircraft have got their own limitations. And what is really to sort of see is this development of the commercial drone sector and commercial equipment and hardware and operating procedures and software, which is really sort of developing in the middle. We've had military drones, since the Second World War. So we're finding this technology, which was once only at a level and really commercialized at consumer level, is now starting to find this maturity at a commercial and professional side of the market, which is really giving us the opportunity to expand and really sort of grow that sort of sector. If you're looking at the drone as a services business, always the big question is, a lot of people sort of ask, say, Chris, really how big is this industry? Really, what is the sort of the potential size? And we've been busy in Africa and have really grown that into a strong and a profitable business, our African business units. And looking at those sort of similar markets in which we could really grow into. So showing some of the culture, not only from let's say from a language point of view, but also in terms of the industries and operational sort of mindset. And leaning on all our experience, what we've learned in Africa, we really sort of actually been looking at that for the last 4 years. We did a reverse takeover with a previous listed business called Parazero. Early this year, we completed the transaction and relisted right at the end of 2020. And really, when we were doing this research and looking at coming into the Australian market, and particularly even the mining industry, we really sort of commissioned some research to look at what's the spend in the professional services sector. So not the commercial, not just the hardware or the software. What is really spent on drone services as a business in Australia alone? And the Drone II guys came back to us with a sort of a $620 million sort of dollar figure. And we sort of took that even quite aggressively and said, well, even if we're looking at if we take a conservative view and say, well, in Australia alone in a single year, if we're sort of looking at the $400 million spend in a single year, we've really, as a board and as a team locally, even though we're very new in Australia this year, we've set it our goal to achieve a 20% market share of that. That's really where we're sort of setting as our North Star, where we're going to be taking this particular business, because we're seeing that customers, again, are not, well, drones are sort of sold as being very easy. They sort of get this, it's a misperception of what they're getting from the consumer drone side. Yes, it is very easy to sort of pull your drone off the shelf and go fly and take photos. But actually what customers want is they don't just need a picture, they need actionable, quantifiable data that they can actually use and ingest into their services and drive autonomy. And actually, this is quite a great sort of picture that we sort of got here as well, because some of the projects which we're working on is we're even seeing automation come in the form of sprayers. Agriculture now accounts for our billing internally. We actually see it as one of the long-term markets in terms of the size. We love the mining industry because it delivers a lot of consistent annuity-based revenues, and I'll chat a little bit about that now. But we're seeing the opportunity in agriculture and the maturity of how customers can inject that into their autonomous sprayers and combine harvesters as well. Really sort of really only starting to take off now. So it really is, even though drones again have been around for a long time, the actual applications of that drone data are really sort of starting to come into their own. A little bit about our group structure and our brands and how we've kind of really built this ecosystem. As mentioned before, we really started off with this Rocket Mine brand about 10 years ago, and then saw this opportunity to develop the Rocket Farm brand. The Rocket Mine brand was really kind of started off on putting this body on a mine site, really working with our customers to achieve a particular price point. So we got some customers like Newmont who have really said to us that, price is everything to them. They want to be very aggressive. They gave us a price point of X, and very similar to like a sort of car finance sort of program, we would say, well, if you only want to pay X OPEX per month, this is what you've got to take out a 5-year deal. And they said, done. The same things happened with South 32, or now Seriti Power in South Africa as well. From a thermal coal perspective, it was a price thing for them. They need their data. It's critical for them. We fly every single day on those mine sites, and I'll tell you a little bit of a story about COVID later. But the idea is that they cannot go a day without this drone data. So we've got the backup equipment, the support services, everything there for them to allow them to get the data that they need, and it generates this annuity income. So generally, our business model is built on we upfront all this money only once we get a purchase order. We obviously recover that over the life of the contract, but then the assets remain ours. It's on our balance sheets as well. And what we're finding is that customers who might only initially take it a 1-2 year or even a 5-year contract, they're renewing. We've been with South 32, now we're going to go into 10 years of our relationship with them. So we're tracking the life of these long-term projects and mines as well. But we're also understanding that the margins will get under pressure as mines that generally are sort of orientated as sort of a race to the bottom. So this is when we created the agriculture brand as well, and the margins are a lot easier for us there. And what we're seeing is that these customers, especially on the Rocket Farm side, in the precision trials, are using our to do plant counting, using AI to do pest detection, weed analysis, which I'll show you a couple of examples. The next step in our brand sort of development was what we called the DSL brand, or our training school. So we were really, our formula is being able to execute and up young people to put them on mine sites very, very quickly. And a lot of that, we're sort of always under sort of pressure by the mines to hire local community members, which is, sort of, I kind of call it like our sort of McDonald's model, is we want to be able to take anyone, be able to put them on a mine site, set up, build operating procedures so that the person that we're putting on site really just has to press a couple of buttons and they look like rock stars. And that's where our DSL brand has really come in. And this is something that we developed internally within Rocket Mine and have sort of spun out in its own right so that it can be commercially accessible there. And here it's remote pilots or licenses, BV loss training as well. And it's sort of standing on its own 2 feet. As mentioned earlier, we then merged with the ParaZero business, which has got autonomous safety systems. So very much like how you have airbags for your cars, which have now become a safety standard. The same thing with the ParaZero technology as well, where regulators in Europe and especially like the US, that anytime you want to conduct drone operations in urban settings or flights over people, you need to have a safety system attached to that. And ParaZero is one of the only very few systems in the world that actually have got what they call ASTM rating, which allows us to, which is a sort of an accreditation certification by the European agencies. A lot of other sort of exciting things where we've sort of been pulled into is that even though some sort of the bread and butter it's survey data which might come out of the mines, some projects we've seen some of our announcements has even been about providing security. So sometimes using the same drone and same equipment during the day, which is providing survey, you attach a thermal sensor to this, and then all of a sudden we're using the drones to detect people hiding in bushes and along routes. And this has been particular for one of our customers, whereby during a sort of a 5-kilometer haul truck road, they couldn't transport their product at night because their trucks were really getting shot at and hijacked in Africa. So by putting on a 6-man team and 24-hour operations, we've been flying these drones, again, night rating, beyond visual line of sight, using the thermal sensor to detect people hiding in the ditches. And ever since we've been operational on that contract, there hasn't been an incident. So you're really finding the application, even though industries might say the same, the applications are really growing in how we use different sensors. We're looking at exciting things such as LiDAR. Our team has been really busy, making full use of where there's really a resource restriction on manned aircraft and manned LiDAR. And it's still there and still be there for the next couple of years due to COVID, where manned crews cannot travel the continent or can't get into countries as they used to. So we've taken full advantage of that using drone technology and building up the sort of scale economy, even coming in at better pricing to be able to help mining customers with the expansion projects, mapping out the jungles, and really sort of seeing through that tree line using LiDAR technology to deliver those models. So as a sort of a quick example, I've actually just been out on the ground this week in Kalgoorlie on the mine sites with customers. And, sort of the first thing is when we say, well, we're a drone services company, and say, oh, well, that's not unique. That's never really been done before. And while I agree, sort of flying drones and doing on a mine site is not unique in itself. It's actually what our business model is and how we pitch it from a commercial aspect has really got minds rethinking about how they actually do it. So right now, I would say like our biggest competitors are our customers themselves. You've got big customers like a BHP Billiton, who's trained over 350 pilots. Glencore's got over 200 pilots of their own. And they're training up these really expensive surveyors who are charging, especially now with labor shortages, they're paying a premium in labor to have these guys standing out in the sun flying drones for half the day. It's crazy. And really when we're sort of coming along with our sort of this fixed price, where we're coming in with a junior whose job is to focus on drone acquisition. We're not here to take away the surveyor's jobs at all. We're primarily there when we sort of talk about the phase one of our business model, is here to own this real estate, come set up with all the processing, hardware, software, everything needed on site, go out with our specialized equipment to acquire this data really quickly, really fast, really focused. And once we've come back and we've processed all that data, you can then output that to many different departments, many data sets as well. And you're paying one price, and it's kind of like an all-you-can sort of eat sort of from a drone data. And we've only really just begun to sort of scratch the surface on what you can actually do, because while some of you've got internal users who are using it for volume calculations and to manage the effectiveness of those drill and blasts sort of plans. We haven't even really considered what are the external users of this drone data as well. In the opportunities which may exist, and when you de-identify the data set. So, we're, for example, on a lot of gold mines situated in Africa as well. So we've got a really sort of an ability to understand what's the volumes that are coming up from the supply chain side of that market. So it's sort of, we've sort of created this this opportunity by having this access to all this data, and it's really about getting to this phase two of the business. I guess sort of quick things, and these are also available on the individual sort of brand websites as well. Rossing, which is previously a Rio Tinto mine based out in Namibia as well. We've been helping them monitor using drone data pits to monitor their high walls. We're able to take these really high resolution photos, build these very accurate 3D models, and then start applying very clever AI detectors, which you can train to detect anything. And in this particular case, it was around detecting cracks. And if any of you have known, if you work in a mining environment, high wall failures and collapses are the biggest sort of concern. And this is what we're assisting with, is because drones speak to the frequency of the data, and actually the more you fly a drone, the cheaper overall that it is. This is where it plays to its strengths. And so high walls every single day have really proved a critical part of Rossing's ability to conduct their operations safely. And it's not a case of they'll never not use a drone. It's just about how do we just keep up with technology and keep making sure we've got the better sensors on site, and making sure that these drones, even in themselves, become more autonomous and a lot more sort of cost effective as well to operate. At a very high level, looking at the Rocket Farm sort of brand, we're working on really cool projects. Again, using the very same techniques that we learned in mining, we're now using in agriculture. We conducted this sort of livestock survey for an accounting firm. They had a sort of a year end. They in previous years they had to send 5 article clocks to count over 200,000 heads of sheep, sort of by moving them through a paddock one by one, and it took this sort of nearly a week to conduct. But using drone technology, you do a single flight in half an hour. Again, train up the AI detector, look for the heads of sheep, and we can sort of count this in a couple of days, without sending out anyone out to site, putting them in dangerous conditions, and providing them this highly accurate visual confirmation of data as well. And that's again also lent us to look at the renewable sector. Again, when we're sort of pocketing our teams within these brands, we've found that our sales and our marketing efforts become really highly specialized, and this is how customers enjoy being spoken to. And using drone technology and the thermal sensors on board, we're able to really even do interesting projects, such as sort of monitoring solar plants. And in this particular case study was what they call a solar concentration plant. So there's sort of a thin sort of tube that runs, and you've got these mirrors that are concentrated on that tube heating, sort of heating the liquid inside, and sort of providing the heat and steam to sort of provide to run the push the generators. And there's been no way to be able to monitor these mirror leaks along that little pipe, in contrast to photovoltaic sort of panels, which have sort of now become the norm. So we're really kind of finding as a team, we're sort of developing into ourselves, looking for these scalable opportunities, and slowly adapting our techniques and our sort of AI to sort of provide this first level of identification, raising that flag for our customers. So yeah, I think the important thing is to really know is that we're, it is very, very early days for us. I guess it is, we started off as a collective, as a group early on this year. I moved into Australia in March this year, and it's really just been about focusing, especially initially in the first couple of months, of just sort of sorting out the merger, reorganizing all the groups, and really sort of focusing on deliver that revenue growth, and especially on the local. Australia is our new focus. This is where we believe that the market is an opportunity. If you look at just the size, again, the size of the market right now, you've got over 1,400 registered commercial drone operators, but they're all 1 to 3 man size businesses, all delivering between $500,000 to $1 million each. And really our goal is to say, well, there's this organic opportunity which we're growing. Like I said, been on this week on the mine sites. Our commercial model very well received, and we're really quite excited. But you can see the light bulb moments when customers are saying, "What, I can pay I can get a better price, and I can reallocate my surveyor to other tasks." And we're like, "Yes," and they're like, "Send me a quote." And so we're seeing that organic sort of acceptance, like actually it's so easy. It's just no one's about just putting the right sales and marketing effort involved. So I think we're ready to seeing that very quick response, and that's just just sort of been with being on the ground here the last couple of months, and now obviously with the boards slightly sort of opening up, it's made it quite easy to get in front of customers to explain the difference. So organic side ticking the boxes there, but where we're seeing is the opportunities is also in the acquisition side as well. I see Mark, am I going over time with you?
Yeah, just slightly, Chris. I want to just like squeeze in a few questions into the last few minutes if we could.
Okay.
I might just kick off the first one. It's a question I've been asking a lot of people. Supply chain issues. Obviously, you want to grow the business now in Australia, but in terms of getting drones and kit and everything you need actually into Australia, and presume these are made up in Asia somewhere, whether that's Taiwan or China or Japan or where. How difficult has that been, or has it not really been an issue for you so far?
No, it's the type of the chips used are are not the ones that are used particularly in the drones and the drone autopilot. So there are different systems involved. Our systems primarily come out of Europe, and we've actually built up because of the size of our operations and the size of we've built up these long-term enterprise contracts with these OEMs. So we're able to indicate when contracts are coming on board, so they sort of have a 30 to 60 day sort of lead. So we've pretty much smoothed out that supply chain process from a perspective.
Okay, great. And then a second question then, in terms of CapEx required, I mean, how much of an upfront cost, if you get, I don't know, like a BHP Olympic dam or a fire trail from Fortescue, like how much of an upfront cost do you guys have to front in terms of buying all this kit, training up people? Is the CapEx very intensive upfront, or I'm just trying to get a sense of that in terms of how the cash flows work over the life of a contract.
Yeah, so your CapEx can range anywhere from about $120,000 to about 180, depending on the requirements of the customer. So and that you're going to sort of recover with a very healthy rate over a sort of a 2, 3, or 5 year sort of period. So we only spend the money once we have the order in hand. We're finding that in the terms of, let's say, a 2 or 3 longer term contracts, we're breaking even for year 1, so generally sort of in month 10 and 11 is our sort of a break even point once all the equipment's actually paid off. And this equipment generally lasts we sort of write it off over a period of 3 years, but we've had some equipment again that's even lasted to 5 years. So what you're finding, especially in this business model, is that in the beginning, not only do the revenues sort of start off slow, the margins sort of start off average, but actually over time, again, as the economies sort of grow as time goes on, we can reuse and replace, and if a wing breaks, you kind of snap on a new one. Our profit margins really sort of start taking a jump. So for us, it's a long-term play. It's not a quick sort of a get-rich-quick scheme.
And in terms of, and you might be covering this in the quarterly update tomorrow, but customer concentration in the business now? Yeah,
so as sort of mentioned, our primary focus has a lot been in the mining sort of sector. So we've probably got about over 22 contractors in that space. We've purchased a local business called Arvista based down in Perth. So that's the team I've been spending with a lot here. Primarily, a lot of their business has been about ad hoc work, project work. They've really got some really great big names and customers, and it's just about transforming those now from this project work into contract work. Saying to customers, well, you've been working with us for over 5 years already. Why not just give us a longer term commitment and we give you a better price? So a high sort of concentration in the mining sector, but again, we've sort of signed up our first big agriculture customer on a long term contract, also very recently as well. So again, it's sort of a part of the market that we're very excited about.
And then a question from the audience. Let's just try and squeeze it in. Why the separate business structure listing on the ASX versus the overseas holding company? Bit of a technical one.
So yeah, I guess just with thinking about the timing. So we obviously use the Delta Drone International sort of as our holding company, and then we operating subsidiaries in Australia as well as Israel and Africa as well. So I think it's just important to note that, especially in places like Africa, you've got to have local sort of a local presence or company set up there in the prime. So we don't necessarily set up in every country in which we operate in. We are taken to a lot of new countries with our customers, which is really great. We're always very conscious. We run this business very lean and mean. We only would set up, let's say, a fully serviceable branch if we're having 3 or more contract country. But it's really important to note that as a drone company, that we've got licenses and compliance. You know, we're really almost treated like airlines in the kind of the safety and the quality systems that we have to carry as a drone company, and to have all of that, you need structures in place.
Okay, great. Thanks, Chris. And let me just check. No, we don't have any further questions, I think, from the audience. And then tomorrow morning, your Appendix 4C is going live, and the details of that event are, 10:15 tomorrow.
Yep. So anyone else who'd like to sort of join us in the last quarterly update would really be great to have you all on board.
Okay, great. Chris, thank you very much for your presentation. And let me just see, is Brian, I just got to wait for Brian to come across. Here he is now. So if you could stop sharing yours. And we'll just get Brian here. Hi, Brian. Can you just unmute there? Hi, Brian.
Hi, how you going?
Good. I will get your presentation up for you now. I know you've just sent it to me this second. Just bear with me 1 second. Okay.
So if you can just forward to the next slide when I ask, please.
No problem. Let's see here. Okay, let me just share this here. Why is that coming up now? Just 1 second, Brian. Go back to here. There it is. Start. Okay, Brian, can you see that cover slide now?
I can, thank you.
Okay, should I tab to the next slide for you?
Are we starting now?
We can start now, yes, if you're ready.
Yes, I'm ready, thank you.
Okay, let's start with this slide then.
Shall I begin?
Yeah, please do.
Excellent. Thank you, everybody, and welcome to the third quarter FY21 key highlights for Nutritional Growth Solutions. This quarter, we saw $818,000 in cash receipts, which is up 92% on the previous corresponding quarter. Revenue was at $630,000, which is 39% on the previous corresponding quarter. And this quarter is all about penetration for China and Southeast Asian expansion, as well as retail expansion in the US. I'll speak more about that in a moment, but as you can see, we've had some very good highlights in the company, particularly the Chemist Warehouse agreement for distribution in China. That's a terrific coup for the team. We've launched new products, we've appointed new senior leaders within the company, particularly expansion of growth into China, and most importantly, we've raised capital, which is important to accelerate that growth in the US and internationally. So moving forward, if I show you the actual year-on-year growth, looking at the financials, we can see that in the first 9 months of 2021, we already significantly passed the results for 2020, which obviously indicates a significant growth of the core business. And one thing I'd like to draw your attention to is our gross margin, which is about 50%, and the industry standard is only about 10%. So the way that we're able to do this is by selling scientifically proven patented proprietary products. And when we're looking at when this business is going to become profitable and start yielding dividends, this is something that a very healthy gross margin is going to get us much closer to. And you can see there in that financial report that for the first 3 months in this last September quarter, we already surpassed the whole revenues for the previous year. Next slide. So accelerating rollout in the Chinese and Southeast Asian market, this is key for us. And I mentioned earlier that this quarter was a lot about preparation for this. And the biggest piece of the puzzle was probably the New Zealand production that we're working on right now with our partners at NIGN, with the expectations that the product release, and it will be in China in the first quarter of 2022. In the meanwhile, we are getting supply agreements and distribution agreements so that the product will be released early next year and will be shipped directly to our distributors for sale. We signed a supply agreement with CWH, who are selling through their initial order with us. We also signed distribution agreements across 2 board of e-commerce distributions into China. And then once our physical product is in China, we can go ahead and make a filing for general trade registration, which will facilitate retail sales in China. So the opportunity for NGS coming to China and Southeast Asia with a clinically proven product to help children grow taller is immense. And it's going to be all about the execution. With our new experienced team and already executed agreements, we are hoping to achieve significant growth in this market. Next slide. So continued expansion of product range in US rollout. The second major initiative that we're working on right now is the expansion to retail in the US. This quarter, we boosted our product offering with our new formula for children 10 plus old. We got positive results from our clinical study and we launched the product in the US. With birth rates declining in many places in the world, the big opportunity and the focus shifts to the older age group, which also doesn't really have many alternatives out there. This is a blue ocean for us, and we are well positioned to succeed there. We've done a lot of preparation that is needed for our retail expansion. Next. You can see we've got this growing product portfolio. One of the key things for us is in retail, we'll be dominating the shelves, which is easier as you've got more products, and we're entering 2022 with a whole new suite of products, which are including this new Grow Daily, 3 plus, the 10 plus, the snack bars, and the kids protein packs. So we're really expanding our portfolio, which is going to make us more interesting to the bigger players, who knows, maybe like the Nestle's and so forth. Moving to the next one. Key appointments to drive future growth. Well, we've recently added Steve Turner, Vicky Wow, and Linda Liu. These are key strategic hires for the company. This is what's going to get us into China with a successful rollout. They're great additions to the team, and I've already met all of them. They're really very experienced. And, we're expecting big things from them as we've got the products, and now we're just rolling them out with their strategic input. Next. So our key priorities in executing on our 3-pillar growth strategy. In the next 12 months, we will continue to execute on this plan. With New Zealand production expected to be completed in the first quarter of 2022, we can finally execute on our China and Southeast Asian rollout. Later, we also plan to bring our products to Australia, which would be exciting for the many investors who want to try our products. In addition, we're actively having discussion with potential distribution partners for Europe. And so you can see that this is the company going forward. I think we've had an excellent quarter. we're going to continue to kick goals and expand our sales into those key territories, expanding through new sales channels and expanding our product platform. So I want to thank our investors for listening to this call. I'm happy to take any questions, and I appreciate everyone's time. Thank you, Mark.
Cheers. Thanks, Brian. I might just quickly go to the next. Yeah, I'm just going to leave this slide up here while we're doing the Q&A. If anybody wants to note down Laron, who is the CEO, she's actually based in Israel, but you can definitely reach out to her for any IR queries. So I'll just leave that up there. Brian, let me just kick off the questions if I may. Quarterly changes have been a little bit lumpy, but as you say, year over year, when you look at a full 12-month basis, you know, it's exhibited very strong growth. Can you talk to us a little bit about the seasonality in the business currently?
Yeah, sure. Thank you, Mark. So it is, in fact, that this the June quarter and the September quarter tend to be, or should I say, the September and December quarters tend to be down quarters in the business. Historically, if we go down quarter to quarter, they tend to be down, and then it's particularly in the US spring summer period is when sales increase. Now, I'm not entirely sure why this seasonality exists, but it certainly has for the company from its first day. So the record quarter that we generated the previous quarter was a significant lift over $1 million. Yet the fact is that although the September quarter tends to be historically for the company actually the worst quarter, we still generated more than we generated the entire last year in sales. So it actually does go to show the growth in the business, which is phenomenal.
And then a second question, in terms of further clinical trials, either that are underway that we can expect results in, or that you're looking to undertake, you know, to kind of further validate the products, is there anything that we should be watching out for, like key results or trials that are going to be happening in the next quarter or the rest of this financial year?
Well, we've already now launched this Grow Daily 10 Voice Plus, but we do have a clinical study that is of interest to me, and that's particularly for children who are taking stimulant treatments like Ritalin. And the fact is that these stimulant treatments actually stunt children's growth. So we are doing a clinical study in Israel, and that's to combine healthy heights with children who are receiving stimulant treatments like Ritalin, and being able to measure the changes in their height and whether or not their height is actually improved as a result of the addition of the Healthy Height product, which is actually being stunted, or their growth is being stunted due to the stimulant treatment. So that, for me, is, I think, a very exciting clinical program, because if we can show there's a medical benefit in combining with Healthy Height, then given that stimulant treatments for kids who, say, have autism or ADHD, these drugs sell in the billions and billions of dollars per annum. And if we can combine Healthy Height as effectively part of the prescription for young children who are on these treatments, then that is a massive new market potential for NGS. So that one would be one that I'd be particularly excited about the results of next year.
Will that be, you say next year, is that going to be before the end of financial year 22? So like in the first half, like, of calendar year 22, should we be watching out for that?
Well, we've already started the trial. We're following the kids for 6 to 12 months. So it won't really be until probably the second half of next year where we get the results.
Okay, great.
But it is a proper clinical study.
Definitely noted. And in terms of, I know the Chinese deal is one you've been working on for, I think, the best part of a year. In terms of moving into Europe, I know that in the presentation you mentioned some initial trial success in Italy. Is there any major markets you're targeting there, or are you just going to, expand on that initial Italian trial and go with that as a kind of as a first stop in Europe?
Are you talking about our European expansion?
Yeah, the European expansion. I know you mentioned the Italian trials. I think it was in this deck. Is that going to be the launch market for Europe, or are you looking at, UK, Germany, France, Spain?
It would certainly be, it's the launching pad for Europe for us initially. We do have plans to expand into other countries in Europe, but the key here is that we're still relatively a small company. We only have so many resources, and you can see that the key hires that we've made have all been in the Chinese, Southeast Asian expansion space. So we're clearly focused now on getting market entry into China and also Southeast Asia. There's obviously a tremendous market opportunity there. And we already have a penetration in Italy, and we're generating excellent sales in the United States. So, and I mentioned also in this announcement, this presentation, about our plans to enter Australia as well. So as far as the rest of Europe goes, that will happen. But clearly the major focus is going to be in China. And part of the Chinese expansion is very much about the New Zealand manufacturing. It's very much part of the branding of the product to have it labelled that it's manufactured and packaged in New Zealand, which is at a particular sweet spot with their Chinese relationship. So we will go after all these additional markets in time, but we have to focus our priorities on where we think we're going to get the best shareholder returns.
And in terms of the US business, if we can just go back to there, is there plans for, getting it into more stores, a ramp up in e-commerce? Maybe just talk to us about the US strategy and how you can continue to grow that while waiting for China to ramp up.
Thank you. So we've got the Amazon sales, which is predominantly the major sales channel for the company, and that's doing extremely well. We have also got a relationship with a large private pharmacy industry group that we can move. Well, we are now moving into their shelves, so that's going to provide even additional exposure for retail sales to have it actually physically on shelves. But I guess for us, in the US expansion, there are some big name industry retailers that we have been talking to. I'm not allowed to name them at this point in time, but they are certainly household names. And if we can get the distribution agreements with these companies, and we've certainly been talking to them, then that's a big game changer for us. So that would be very much expanding into the retail shelves, which is something that I'd love to see. I think that the product sells itself. It's well packaged. It's clinically proven, and retail sales is a good one. In addition to the online sales that we're doing. So these are things that are going to, I think, come to light over the course of time, and I'm optimistic that these big deals will come off.
And just remind me again on production for the US market. That actually happens in the US, correct?
Yes, so the production is actually happening in Ohio and always was. And that's where it's manufactured and packaged. And that's for the US market. But for the Chinese market, we've expanded to produce in New Zealand. And so that New Zealand production should be coming online by around the end of this year. So that's how we're going to manufacture and sell into the Chinese and Southeast Asia. And obviously the Australian market is through the New Zealand production. So we're not going to stop the US production. That's going to continue to supply the US market probably also the European market. But it's important for us to expand our footprint into the Southern Hemisphere, particularly New Zealand, so that we can really capture that Chinese market.
And the initial products, if they were to come to New Zealand and Australia, is that literally a straight production run of what you're currently doing in the US, or is there specific products going to be done for the Australian, New Zealand market, or is it literally just copying what they're doing in Ohio and just putting that into the production facility in New Zealand?
It's essentially just it's the same product. It's a bit like Cadbury. They've got manufacturing facilities around the world. They still produce the same tasty chocolate. The same thing for us. This product is the same, but being branded as a New Zealand product is actually very beneficial from the market research that we've done in terms of expanding into China. So that is probably the biggest driver for this to happen.
Just check if we got a question coming through from the audience. 1 second, Brian. Just bear with me. Not at this point. I know you said you raised some capital just recently. Can you give us an idea of what the shareholder register looks like now, kind of post the last capital raising?
Sure. Well, we raised $5 million. We did it at a slight premium to what we initially IPO'd at 20 cents. So the capital raise was done at 21.5. This was new strategic shareholders of the business, largely retail, and the retail shareholder base isn't much changed from the time that we IPO'd just probably a year and a half ago, not even that. So we do have the Israeli groups that are predominantly the largest shareholders. They're escrowed as well, I might add, but they're very much backed the company, so we're very proud to have them on board. And the investors in the Australian market are predominantly retail, and it does suit a retail investor base, considering we are a retail product. We're only really starting to get our skates on in terms of the new programs that we've got launching, particularly rolling into China, and that's what's going to pay dividends for the shareholders. And so we're very confident. I might add, in terms of shareholding, we recently had an EGM that I had that was put on so predominantly so that I could get my $50,000 investment in the company through the last placement, and need to get that ratified by shareholders. So that was done. So I've gone and made another significant investment for me in the company, as has my other Australian colleague, Antonio Barros. So we're very excited about this investment and moving forward.
And in terms of I know you talked to the Chemist Warehouse one, distribution agreement. Will it be a two-pronged approach? Retail, bricks and mortar retail plus e-commerce, or is it going to be primarily bricks and mortar to start off with, and then just build up the e-commerce business once kind of people are familiar with the product on the shelves?
It is a combination of both. As I said earlier, I think this product is something that would sell itself on the shelf. It's got a great packaging to it. It's clearly proven. It appeals to parents who are wanting to get the best for their children. So it is going to be an on-shelf sales. We also have Tmall Global as distribution partners online in China, and we made some new announcements in terms of the Ultra Health Group, which is also now an e-commerce facility which we are using to sell to China, and Australia Sunshine, which is going to distribute the products to the Southeast Asia and China, so through their JD.com, TikTok, e-commerce, Lazada. So it's a good combination of having Chemist Warehouse to actually stock it in their physical stores and also through their Tmall Global distribution.
Okay, perfect. Just give me 1 second, Brian. Brian, I know we're finishing a minute or two early, and I appreciate that you obviously need to, as you told me, get to a conference that you're attending for NGS over in WA. So we might finish up a minute or two early, because I do know Ben, our next presenter, is standing ready to jump on. So maybe we'll just end today's presentation for NGS, and we'll hand over to Ben, if that's okay with you.
Thank you very much for having me.
Thanks, Brian, and thanks for squeezing us in this morning, given I know you're leaving now straight for the conference. Thank you.
Okay. Thank you, Mark. Bye.
Ben, I know we're a little bit early. If you're ready to go, then we are. I see you are. If you can just maybe make that full screen, Ben, that'd be helpful. Yeah, just try that. Go to full screen mode.
Thanks, Mark. Is that better?
Yeah, now it's better. We were just losing the kind of bottom third of your slide there, but that's looking much better. Thanks.
Great. Well, thanks, Mark, and thanks everyone for listening in. No, it's been an exciting quarter for Wide Open Agriculture again. Our ninth consecutive quarter of growth, which is really exciting. But also, I think this quarter has really solidified our position, and also really shown that we're catching these really prevailing tailwinds. The tailwinds of people seeking healthy, nutritious food. I think the COVID pandemic we've all experienced that shift towards a sentiment towards what you are eating and how important it is to your health and your family and loved ones' health, alongside a move towards plant-rich diets. And you'll see that our oat milk and lupin programs have really significantly advanced. So we really feel like we're in an exciting space, and also we feel like our for-purpose, for-profit mission is really starting to take shape. The ability of the food sector to tackle accelerating climate change is vital. We've got to get electricity right, we've got to get transport right, but we've also got to get food and farming right as well. And we feel like we're making some real inroads there as well. So as I mentioned, it was a great quarter from a revenue point of view. It's sustained double-digit growth, just over 17% quarter on quarter. I'll talk to more detail around that in the following slides. So that's the brand, the food brand, Dirty Clean Food. We're seeing some really strong growth. The oat milk, we've really solidified our distribution agreements across Australia and Southeast Asia, and can see some real sort of excitement growing in the market around the proposition, around both taste and mouthfeel, but also the value behind the story behind the oat milk and its provenance. And also the lupin program, the Australian sweet lupin protein that we've been working on now has really got to a stage where we're now sending out commercial samples and really starting to understand the immense value that this product holds. So you can see there, really, it's a really strong period of growth that we're experiencing. And as that base gets stronger, still we continue to perform, which we're really excited by. And to us, both the board and the management team, what excites us is that it's proof of concept that the term Dirty Clean Food, the brand, is now solidified. It is now understood that customers are willing to pay a premium for a food product that relates to their values, both social, being fair to farmer, and environmental, fighting climate change through the food they choose to eat. The bank balance, the cash balance is still strong, and we really feel we're poised for much more growth. I'll talk now about the Lupine Project, and why I'm doing it in that order is we see it as a real strategic opportunity for us, and it's getting all of our attention and resources internally. So the Australian Sweet Lupine program has always been one that started as a science project. It was in the laboratory, and now it's rapidly advanced into what was a food and drink ingredient opportunity for ourselves, Dirty Clean Food, and for international and Australian food and ingredient companies. And what we've most significantly done this last quarter is got to a point where we're making food grade quantities of the protein, and we're sending it to hand-picked companies that have aligned philosophies around sustainable and healthy farming practices, but also have really wide reaches across both the ingredient and food companies. So that to us is really important, because now, of course, we're getting customer feedback on the product, which allows us to really understand a much better valuation around our average sales price and also the potential demand going forward. We've done a very extensive competitive analysis. Obviously, soy is the behemoth in the plant-based protein market, a $5 billion per annum market. And when you look at the column, and this was in a recent announcement that you can have a closer look at, when you look across the sort of key traits around protein levels, it's the same as soy. It's better than soy. There's no GMO version. There's no genetically modified version of lupin. So customers, and a lot of our customers, choose not to include genetically modified foods into their diet. That's a nice point of difference, as is the no phytoestrogens as well. So a couple of really interesting comparative advantages there against soy. And we do really see this kind of prevailing sort of market for plant-based proteins is starting to push up prices across soy, pea, fava bean, and other sort of smaller plant-based proteins. So we see lupin very likely falling into that pattern, which is exciting for us. The technical team is really strong now. We've brought the PhD. He was a PhD candidate when we first met him 3 years ago, now fully qualified. We've brought Dr. Al-Ali into the team. He's probably one of the world's leading sort of protein chemists with a focus on Australian sweet lupin, and a really strong engineering team to support him to build out the pilot plant and the process flow in-house. So what are we actually doing with the protein? It's important to understand that we're looking at it across a number of categories, and a number of very, very large categories. Internally, we make a great oat milk. So of course it made sense when we took the protein to add it to our oat milk, and we got a very positive response. Hopefully putting out some future news around the sort of the product taste and sensory update on a high protein oat milk. And why that excites us is because one of the nutritional issues around oat milk is it's lower in protein than dairy and soy. So with our lupin, we can add it so that it actually has the same comparative levels of protein as dairy milk and as soy milk. So it really removes any reason for customers not to choose our oat milk. And I think Oatly has shown just how big the market is for the mouthfeel and the taste and the profile of oat milk. We're seeing that with our own oat milk. We believe with a high protein oat milk, it's a really exciting comparative advantage that we want to take to market with real strength. But also, because of this gelation property that is so important with our protein, we can also apply it across the meats, the noodles and pasta category or baked good category, but also as a protein formula as well, where you just add it to a shake in the morning. We've confirmed where we're going to do it. Our distribution centre in Kewdale, just outside of Perth Airport, has sufficient space. So that's an important sort of infrastructural decision, and that's where the pilot plant will be located. And the advantages of us taking it in-house, previously we've been using the great contracting manufacturing services of CSIRO's Food Innovation Lab in Werribee. But the importance to us strategically to bring it in-house is that we can really start to build our own trade secrets and know-how. We can really start to build out a product line that matches the requests of customers that we're now having very engaging conversations with, and also allows us to explore our technology beyond Australian sweet lupin. Australia grows great fava beans, chickpeas, lentils. These are all potential pulses that we could bring into our plant-based protein program. And also it's good to see, being based in West Australia, probably not as an advanced food innovation sector as Victoria or New South Wales, but you're really starting to see some of the state government's policies taking action. And we're a part of a really exciting X-protein project that allows us to really get direct access to Asian and Singaporean markets, both from a technical point of view, customers, but also investors. So we've really enjoyed that program and think it's a real step forward for WA. So that's the lupin program, and I'll now move to our food brand and our oat milk. So our food brand, Dirty Clean Food. Again, just to reiterate, we're just under 7 million projected annual sales per annum, and we're really excited that we're seeing this sequential growth, and we're seeing ongoing sort of reach across not only the online but the retail and the food service. So all three channels are continuing to grow, which again is a value proposition around our quality, but also the provenance, the story of our food. Digital was a real standout this quarter, which excites us because that's where we've been strategically focusing, because we get a better gross margin, because we get closer to our consumer. So that 31% quarterly growth was exciting for us. It shows that when we do make changes to our website and our interface, when we do make good specials and follow the data through, we can get customers to come back more often, we can get more customers, and we can get them to increase their basket size, which is very important to us and our scaled sort of opportunities. We're seeing retail grow, which is really exciting as well. Our independent chains are really growing out. We are now sort of excited by the opportunity to speak to the national retailers all the way across the Coles, the Woolworths, and the Aldi's. We're sort of ready for those conversations now, and we feel like there's great potential there to move forward on that front. OTUP is our shelf-stable product that we've really used as our kind of beachhead to get beyond the West Australian market. Dirty Clean Food, the beef and the lamb, the pork and the chicken, and the online offering is a West Australian only offering. But of course, a shelf-stable product lets us push right out, both nationally and internationally, and that's exactly what we've done. We're really proud to be in some great high-value retailers like Romeo's and Harris Farm Markets, and that proposition really puts us where we want to be. And OTUP really is now recognised as one of the premium oat milks in Australia. We see our expanded product line and range being a very important part of our proposition. For retail, it's about shelf space and visibility. You get about 5 seconds for customers to make the right decision. We want to bring out our barista chocolate and coffee 1 litre variant lines to expand from the original. We're looking at a cold chilled coffee line, which would be really exciting for a summer launch. It's got 2 shots of espresso, and I can vouch for its ability to keep you alert and awake. But also it's really that future launch of the high protein oat milk that really has got our deepest attention in the new product development team and the marketing team as well, because of that real comparative advantage that we're excited by. On the market growth, we're really excited about getting into more Asian countries. Of course, we've announced that exciting deal, the $500,000 deal over 12 months in Singapore markets, and now really focused on the next 3 with Hong Kong, Thailand, and Taiwan, really our priority markets where we see some great opportunities. So I've spoken to this slide, and yeah, we are really excited to be in that Singapore market. It's a premium market, some really savvy consumers there that are really interested in the story around taste, of course, comes first, but also that provenance story and impact on climate change. So now a quick sort of brief sort of summary of what are we focused on this coming quarter. Within Lupine, it's really getting this pilot plant equipment together in-house and constructed into a process flow. We feel very excited by the progress the engineering team are making and the sort of, I guess, the connections we're making with the people that manufacture the equipment. But also it's to get these prototypes of the high protein milk out to market, tasted, pushed to potential customers, both retail but also larger distributors, so people can really understand the proposition there. And also to continue with that sampling process. Obviously, large offtake agreements are our ambition, and we are looking for those offtake agreements across the alternate meats, across baked goods, across plant-based dairy and the protein formulation. So now that those relationships are formed, we continue to engage and see where they lead. OTUP, it's to bring and get those new flavour variants out to continue to build that retail distribution chain. And as I mentioned, to really take seriously the opportunities around national supermarket distribution. And then with Dirty Clean Food, what we're building there has to be replicable and scalable. It's working in WA. We feel like it should and could work in other territories, both in Sydney and Melbourne and Queensland, but also potentially across into Asia as well. So to build that sort of website network, website traffic, to really sort of build our search engine optimization so that when people are looking for food that allows them to fight climate change, they come straight to Dirty Clean Food, and we build that brand presence right across the portfolio. So thanks everyone. Thanks for listening. I know I'm the last speaker, so thanks for holding in there. It's probably been more than 1 coffee for most people, but thanks Mark, and happy to take questions.
Cheers, Ben, and yeah, thanks for joining us early. I know, yeah, if you can leave that slide up just while we're running through the Q&A, that would be great. And yeah, thanks for joining us. I know it's also early your side there in WA. I might just kick off the questions. In terms of margins across the three sections, you know, you talked about it there with the online being better margins, again, closer to the customers. Can you just kind of give us a rough sense of, you know, where the GP margins lie across retail, online, and the food services, if you could?
Yeah, well, we definitely have an ambition for whole of animal utilization. So we actually see the three channels playing a very important role. Probably the key to any animal protein business is being able to sell the mince effectively, the parts of the animal that aren't sort of the Scotch fillet or the sirloin. So what we do is we sort of aspire for a gross margin across those channels. Definitely the margin that we aspire to is 22%. People can see from our 4C we are below that, which is currently tracking at close to 12%. So we've got some work to do there, but what we feel confident about is that growth in digital. So digital allows us to sort of control our pricing and respond to pricing much quicker than retail and food service. So that is the margin, that is the market where we look for a 30% gross margin, and that's across all of our product lines. We also do our Friends of Dirty Clean Food product lines. We do our vegetable box. So we see the ability to sort of package up the boxes, the food boxes that we do, to allow us to give our customers a really fair sort of proposition, but also to allow us to control that margin. So they're the markets, they're the sort of margins that we're aiming for. And beef, as people who follow cattle prices would have seen, beef pricing as extraordinary at the moment, extraordinarily high. So that's a challenge for our business. The way we respond to that is obviously having strong relationships with our suppliers, making sure that they understand the value proposition and that we're in it for the long haul. Everyone knows commodity pricing cycles are always very much aligned to a sine wave, but right now we're going through a peak. So that is hurting our gross margin. There is no doubt about that. But we see exciting sort of movement in the other lines, particularly the plant lines. The veggie box is actually one of our top sellers now, which is a really interesting proposition. We launched that only 6 months ago. So I think those trends that people hear about plant-rich diets, people seeking sort of alternatives to a 7-day-a-week meat diet is definitely starting to respond. And also our Friends of Dirty Clean Food product lines, like the pasture-raised eggs, the milk from Bannister Downs are seeing some really steady sort of pull-through. So we're finding that customers are coming back now more regularly, which is important for us as well, around retaining that relationship with our customer and that consistent spend.
Question from the audience. Although cash receipts have been increasing significantly, cash outflow has also been increasing. When do you see cash outflow starting to decrease? So I guess, you know, when are we going to see this inflection point of, you know, the investments you're making now starting to kind of translate into get more of a cash in? Because I can imagine launching, there's a lot of work that goes into packaging design and, you know, buying packaging and, you know, getting stuff that those first initial orders, getting everything stocked on the shelf. And like, where are you in that kind of initial launch phase cycle to kind of, you know, buying and selling on a regular basis?
Yeah, well, I think yeah, it's a very fair comment. I mean, we're probably at the bottom of it. We're at the biggest gap that we can see forecast this quarter, in that we have had to make investments both across our infrastructure. So we've been previously leasing warehousing facilities. We now have our own. We were sort of co-tenants. We now have our own facility. And yeah, we have had to do both. The key costs really there have been around inventory, around the oat milk, also building up our inventory around our beef and lamb as well, to ensure that we had sufficient and to sort of capture sort of lower prices at this point. But also those marketing costs as well, those sort of front leading costs. And of course, the people, the engine of the company, to ensure that we can deliver the business as we expect. So this in our forecast is going to be sort of that biggest gap. And what we really see as sort of being the important sort of lever is of course growth in oat milk sales. So that's now reached a point where we're in Singapore, where we're pushing out to those 3 additional markets. So that we really sort of forecast to be a really key sort of delivery point for our revenue growth. And also as the Lupine Project takes sort of more strength, the potential release of the high protein oat milk we see as a real potential game changer as well, along with sustained growth in dirty clean food. So we know we're at that point, that sort of inflection point from startup to growth, where it's very important. Every dollar really matters. And this is hopefully our worst quarter in between in regards to that gap. And from here on, we sort of close that up and strive towards profitability, which is really the ambition of the management team and board and our key focus.
And just if I can touch on the slide where, you're comparing soy versus lupin and a few others, is it a case now of a big consumer education piece to, people, they just kind of, know soy, it's the market leader, as you say, is it you just kind of educating consumers that actually lupin is a better alternative? Because I'm sure the food ingredients guys, they can look at the science very quickly and they get it. But is there just a piece of work to be done on educating the consumer? And that's something you've got to lead, I guess.
Well, we've really learned, actually consumers, that they make decisions based on taste and mouthfeel. And I guess that's why internally we're very excited by this product line, because it has a very high protein concentration, which is very hard to do with plant-based milks without a very sort of strong beanie flavour. So we're not finding that. We're finding it's got a very neutral flavour. So when we've done the initial testing, people are responding very positively to it. Then I think the story around lupin, it's really just, it's an alternate protein source. It's not an unknown word. Certainly in European markets, the lupine bean is well known. So we feel like there's enough sort of familiarity with the term lupin. And really what the proposition is an oat milk that's high protein. Yes, we're using lupin, but we don't actually see that will necessarily be a key sort of selling point. It'll actually just be the fact that it's high protein. So we actually feel pretty positive about that. And also, you're right about the ingredient companies and the food manufacturers. They understand that the gelation properties of this unfolded lupin protein are really exciting. And then it's really just understanding the essential amino acid balance and really making sure it fits within their profile. But overall, it seems like lupin is ready to enter the sort of global market of plant-based proteins, and we'll be sort of spearheading that.
And then just in terms of, the lockdowns, extensive lockdowns we've seen in Victoria and New South Wales, the impact that you saw from that in terms of sales over East, are retarding, I guess, growth over East. Have you seen a bounce back since things have opened up and people are kind of getting back on track over East?
We actually still launched and got out into our retail markets, and of course supermarkets have remained open throughout that period. So we haven't seen any significant difference in this short sort of period that the sort of the reopening has happened, particularly in Sydney and Victoria, and we actually saw good pull through during that period. We also have our online sales, so they've been tracking well as well through oatup.com.au, and also we're on Amazon as well. So no, we've actually found throughout COVID, we found sort of consistent growth in the sales in those markets. But it's a fair point as customers get sort of perhaps more courageous and spend a bit more time in supermarkets, so they're browsing and looking at new brands. Yeah, certainly we do hope that could be another point to push our sales up across there. Also building our above the line and below the line marketing campaigns. We've used social media predominantly in our current marketing strategy. We're now getting above the line, so people will start to see that visibility much more of Dirty Clean Foods oat milk, which we think will be a really nice push for our retail sales as well.
Another question from the audience, Ben. Would the demo plant have the capacity to make a range for a retail chain to start getting customer feedback?
Yes, the short answer is yes. That's the intent, absolutely. So that we've got a pilot plant or a small scale commercial plant that allows us to produce enough volume to bring out a line that can go out to a retailer. Also, the intent of the pilot plant is to build that know-how and trade secrets that really allow us to sort of progress towards a commercial plant. Really strategically, we want this to be sort of at the anywhere from 10 to 30 up to 50,000 tonnes per annum production, which when you look at the sort of million tonnes of soy protein that are produced and sold every year, we feel is a drop in the ocean. But West Australia's production capacity is there. So it's about getting that technology advanced to a point where we can go with confidence and with the right finance partners, be able to take that to a commercial scale, in which state then we are not only providing it into Dirty Clean Foods high protein oat milk, but then of course looking for those much more substantial offtake agreements with people that are perhaps making plant-based meats, gluten-free pastas and noodles, or protein supplements.
And in terms of those food agreements or food ingredient agreements, is that going to be the strategy for some part of Asia, or is, given the proximity from where you guys are in Perth, you know, the Asia strategy, is that plus the retail, as opposed to, I know you've said before when you last presented, you know, the food ingredients is the kind of main strategy when you're looking at US and European markets. But I'm just wondering, is Asia a combination of both the ingredients plus the actual physical retail products?
Yeah, it's just that. Yeah, we do want to we've already taken our oat milk to that market. So we feel like because those distribution channels are already open, it would make so much sense to take our own high protein oat milk into those markets. That's where we capture the most value, of course, because we're pushing it right through from a raw ingredient processed, and we capture value and gross margin all the way through. So yeah, we want to do that with our oat milk and our high protein oat milk category. But then we are currently in conversations with companies across Southeast Asia, from Singapore through to Korea, through to Malaysia, that are interested in it purely as an ingredient. So we see sort of really the B2C model really protected around oat milk and plant-based milks. But we're open to those conversations with ingredient companies that are operating in different areas. It could be for example, a plant-based dairy, but it could be a cheese or a yogurt. We're not currently in that market. Plant-based meats, and of course those alternative noodles and pastas as well is still a really exciting category because of these gelation properties. You can remove wheat and replace it potentially with our lupin protein.
Okay, great. I don't think we have any further questions from the audience. Let me just double check here. No. Ben, I think we started early, so maybe we'll finish a minute or two early. Thanks for coming back and giving us an update on everything wide open agriculture. And it's been great to track progress since you were last here, and we'll continue to do so over the next couple of quarters. It sounds like you've kind of got an exciting 12 months ahead of you.
Yeah, we do. No, thanks, Mark. Thanks everyone for listening in. Cheers.
And with that, I'll end this morning's event. Please do remember that we have another event happening tomorrow morning where we've got another 4 Appendix 4C companies presenting, and I look forward to you joining us for that if you can. And with that, I'll wish everybody a good rest of their Thursday.